We're looking at deferred tax next, together with some bits of basic tax. IAS 12 is the subject of our coverage. If you turn, please, to page 144, you will see that it is always examined as part of question 2, sometimes questions 4 and 5 as well. So let's move from the known to the unknown. In the question called Interceptor, a little while ago, we did some workings for tax. I'm going to draw on that now. CUD, corporation tax or income tax, for the current year, under stroke brackets over provision for the previous year and then you have your deferred tax transfer. If you add that up, you have the income statement tax charge. So what is the under-over provision? At the end of last year, you would have made a provision for a certain figure. After discussion with the tax authorities, a decision is made that you've got to pay a little bit more. So obviously you've been under-provided. That excess amount that you have to pay must be charged in the current year to the income statement. So if you take the 2 years together, it has been ironed out. So that's the first step. That is the working for tax. How about deferred tax? I'll explain the detail of deferred tax in a minute, but let's see what the familiar territory is. Workings for deferred tax. You have an opening figure which comes from the TB, the trial balance, usually a credit balance. Then you have the income statement transfer. And obviously you have your closing balance, which is usually calculated. Crucially, I must indicate that this deferred tax transfer in the income statement is the same as this one. So if that's 120 upstairs, the one lower down will be 120 as well. The deferred tax usually is a credit balance, opening and closing. So do be careful. If your opening balance is, say, 1,000 and the closing balance happens to be 980, the difference will go into the income statement transfer as something in brackets. So you'll have brackets around that if it has gone down in value. Don't forget. Seems like a good moment for us to test our skills against an examination question. That question is on page 145. Let's attempt it together then. Chamber, a publicly listed company, has the following items among many others in its trial balance. So it's an extract from the trial balance. Tax, given there on the debit side, deferred tax at the start of the year. Please underline start. If the question ever says deferred tax without indicating whether it's the start or the end, always assume it's a start. The following notes are relevant. The balance of tax represents the amount left after payment of tax for the previous year. Now you have to use your imagination. If you have provided a certain figure and the amount that you had to pay is more than what you provided, you have an overpayment. An overpayment is a debit item in the trial balance as here. An overpayment equals an under provision. And therefore that must feature as the U in our CUD mnemonic, of which we spoke a couple of minutes ago. So that item of 200, notice the examiner gives you no help as to whether it's an under or over provision. If it's on the debit side, it is an under provision. If it's on the credit side, it's an over provision, because provisions, of course, are credits, as we will see in a later standard, IAS 37. Let's read on. The directors have estimated the provision for corporation tax for the current year at 22 million. The opening deferred tax provision is to be adjusted to a credit balance of 14 million. We have enough information to get started. So in your notes where you're solving these things with me, I'd like you to say chamber, past exam question, of course. Page 145, if that helps. Let's start with the income statement tax, dominated by that mnemonic CUD. Don't reveal it to the examiner. Keep it secret. It's something that is part of your armory. Corporation tax for the current year, 22,000. No problem. Under provision for previous year. Do not call that a prior year adjustment. You'll be marked wrong, because a prior adjustment is where there's a change in accounting policy, and that is not appropriate to this situation. So under provision, charge it this year, 200, no brackets. Over provision, brackets. Under provision, no brackets. Over provision, brackets. Then you have your deferred tax transfer. Not entirely sure at this stage what that is, so what we'll do is to leave some space and rule it off, and this eventually goes to the income statement. Let's march on then to the next pocket of marks, the Statement of Financial Position, SFP, as at the year end, and under that you have your deferred tax, which is shown under non-current liabilities, non-current liabilities. So, what do we have? We have an opening balance of 17,500. In the trial balance extract, it's shown as a credit item. No problem. You have your income statement transfer. And then you have your closing balance. In this particular case is given as 14,000. Now that's interesting. If you recall a couple of minutes ago, I was saying to you that if your opening balance goes down, when you're looking at the closing balance, the difference must be bracketed. And clearly this one is a debit. Very much a balancing figure, nothing clever there. But once you've established that, I invite you to pull it back to the figure up here and slot that in. 3,500. Brackets or no brackets? Brackets. And so the figure there, 18,700. Very easy indeed. CUD mnemonic. The D of CUD is deferred tax. There's an opening and closing balance. The difference goes back to complete the CUD. Very, very straightforward. One other loose end that some people struggle with, I thought I'd take a chance and explain it to you, just in case it's a problem for you, just in case. When you're doing your current liabilities, you see, in your balance sheet. Remember, deferred tax is non-current, but this is current. When you're doing your current liabilities in the balance sheet or statement of financial position, I should say, you have your current liabilities, of course, and apart from things like payables and proposed dividends, etc., you have tax. Now, you remember in the income statement we had CUD. The biggest thing to remember is only the C, the corporation tax, that goes through. And so the corporation tax in this question is $22,000. Absolutely crucial is that these are eliminated. The reason is the under provision has been ironed out by being charged in the current year. So last year's has been sorted out, the difference between the amount paid and the amount provided. As far as the deferred tax is concerned, that's got its own slot. So when you're doing the current liabilities, only show the C. That is to say, corporation tax, sometimes called income tax. But you mustn't bring in the U and the D, otherwise you'll be guilty of double counting. And you're throwing away precious marks. I invite you, therefore, to move on, when you're ready, to the next page. What is deferred tax? What is deferred tax? Right on top, you can say IAS 12 if you wish. Now, here's a little secret expression I use. What is deferred tax? Deferred tax, or DT, is CT on TD. DT is CT on TD. TD is simply temporary differences. So let me just ask you kindly to fill this in with me. DT is CT on TD. Never forget that. I.e., extra corporation tax, comma, at the latest enacted rate regarding the future on temporary differences. The first word I need to explain is the word enacted. Clearly, if the directors are deciding how much to provide in respect of the future on grounds of prudence, they tend to under-provide. They tend to fabricate manufacture rates. So it has to be something that's been enacted by the Finance Act. And you have to use a current real percentage to avoid abuse. So clearly, we have to ask the question, what are temporary differences? So I'll underline that. What are temporary differences? This is easy. Temporary differences are differences that are temporary. I told you this was easy. Now, I'm going to say caused by differences in the timing of when items are treated in the income statement and when they are assessed to tax. The best example I can think of is something called capital allowances. Accelerated capital allowances, and some short-term timing differences as well. But accelerated, the reason why they use the word accelerated is very often capital allowances, which are simply the inland revenues or the revenues, that is to say the tax authorities' word for depreciation. So they add back depreciation, but they give you capital allowances. Just tax depreciation, you might call it. It's usually given at a faster rate than depreciation, hence we use the word accelerated capital allowances. Now, we come finally to page 147 as we consider the detail of what we've just been looking at. Now, this being a slightly conceptual area, I'd like very much for you to participate with me as we fill in some of these gaps. If you write small, we should be okay. So what is deferred tax? Some extra tax kept aside because accounting profit is different to taxable profits. What I am going to do in the next few minutes is explain why that is so. So the deferred tax key concept, you have accounting profit and you have taxable profit. Accounting profit is based, of course, on generally accepted accounting principles, i.e. IFRSs, IASs, indeed any good accounting practice. Whereas taxable profit is based on fiscal rules, things like finance acts. Okay, so let's, for simplicity, say that the accounting profit is 250,000, the taxable profit is 150,000. So the difference is 100,000. We then analyze the difference and provide deferred tax on some of the difference. So in the middle here, I invite you to put in the word differences. Nice big word like that. Now, do you recall a few minutes ago, we said DT was CT on TD. That TD represents temporary differences. But there are other differences, like permanent differences, which you do not provide for. So I'll go through that again. You have accounting profit, 250,000. Taxable profit, 150,000. The difference is 100,000. We analyze that difference. On the left-hand side, we will have permanent differences, things like the fact that dividend income is exempt from corporation tax and certain entertaining that is disallowed. So what's the issue here? Do not provide for deferred tax. So we'll say do not provide for deferred tax on PDs. But you do provide for deferred tax on permanent differences, and it is to that we now turn our attention. You do not provide on permanent, but you do provide on temporary. You do not provide on permanent, but you do provide on temporary. So here are the temporary differences. Things like short-term temporary differences, certain patent royalty receivables. Another example, the most likely to be examined, accelerated capital allowances. Accelerated because capital allowances are given by the tax authorities at a faster rate than you get depreciation. And here you provide in full for temporary differences. If you remember, DT is CT on TD. So that's the system. You may be asked to discuss some of these issues. Now, on the next few pages, I have put together, with the examiner's help occasionally, some words where deferred tax is explained. Take that very seriously. Stop the tape now and scrutinize every word in front of you. Everything up to the question called bow, which I intend to do on the next tape. That brings us to the end of this session. I'll do bow together with some more published accounts on the next tape. Thank you.